Walk you guys through on MLS right now. I'm just going to grab two properties at random, and we're going to go into Excel. We're going to crunch the numbers. We're going to find out whether or not I'd be interested in taking a look at this property. Hi everyone, Mike Rosehart here, talking to you guys today about how to analyze a real live real estate deal. And I'm going to walk you guys through on MLS right now and crunch the numbers. We're going to find out whether or not I'd be interested in taking a look at this property. Before I get into some of the details, I want to let you guys know, if you really are enjoying this type of content, if you're enjoying this style of me talking to the camera with recording my screen and sharing some of the real numbers and the real analysis and how I actually go about doing what I did to get from where I was to where I am today, which is retired at 25. You guys know I work really hard. So I don't define retirement the same way as you guys, might, but if you guys are enjoying that, please let me know in the comments. Please let me know, like the video and share it on social media if you guys are getting value from this. So let's get into it. On MLS, I can see a map. I like the map view. It's one of my favorites. And I'll go to certain locations that I'm really bullish on. And right now I'm just going to pick a location where I have some properties myself right now. It's just south of the university here in London, Ontario. And I think it's a great area to be investing in because you have that diversity. You can rent to single family, you can also rent to students. You just have more of a target market you can rent to. So it's sort of nice in that way. You have to be very careful in this market because the properties vary so widely. I just went and picked two random properties. I haven't even looked into them. I just opened them up here. Let's go to the first one. It was, right south of the university, 137 Columbia Avenue. Let's see, it's listed for $399,900. Let's take a look at some of the pictures. That's a cute house. Looks like it's newer. It's been built probably in the last 25 or so years. It's got nice basement-sized windows there. It's a bungalow-style house. That's it. Not a lot of pictures. Poor listing. It's always better when you have pictures of the inside. Probably a tenanted property and they couldn't get in. Let's see. 3 bedrooms in the main floor plus 2 in the basement and 2 full washrooms. Built in 1999. That's right. So it is a relatively newer property. You'll have less issues as far as repairs and maintenance go on the property, and CapEx goes on the property most likely. So you're going to have less problems, better build quality typically than newer houses than the older ones. As far as, from a rental perspective, it's desirable as well. Description: excellent location, just minutes from downtown and UWO. That's true. They're not lying in this listing. It's a 5-bed, 2-bath house built in 1999, and it's a great investment. Okay, so they're targeting an investor. It's an investment property. Has updated air conditioning, so central air, a new roof in 2015, oversized windows in the lower. Yeah, I see that, egress windows. Property is leased until February 1st, 2019 at $1,700 a month plus utilities. And viewings Mondays and Saturdays. I'm sure you could probably negotiate to get in those other times, but that's probably the time window they give in the tenant. So let's see what else we can see. It's near some public schools, that's true. You could hit this up to a family rental. It has washer, dryer, stove, refrigerator they're including, and the water heater is rented from most likely Reliance. It's a single family zoning, so it's not zoned for duplex. And you can see some of the dimensions of the property here. There's 3 bedrooms on the main floor, and they look to be good sizes. Assuming these measurements are correct, that's a fairly good sized bedroom. In this student area, you should be able to get about $500 a bedroom, inclusive of utilities in this area. And it looks like they have a good sized dining room. So potential, they could make it like an extra office or something, but the rule in London is you're only allowed 5 bedrooms unless you have a grandfathered. So because it says a grandfathered, I am assuming they're capped at 5 bedrooms, so there's not much you can really do to squeak out more rent by converting a dining room to a bedroom. In this case, they got a bathroom on a full washroom on each floor, and so there's not really a value in adding additional bathroom unless you do like an ensuite type thing. The basement rooms, 16 by 10.8, good size rooms, so that should really help. I assume this is rented to students. It's seen that way, but it could be rented to a family also. We don't know until we see the listing. Until we see the property, sorry. Let's go into actually some other quick things. You can see it's natural gas heating. It's a poured concrete foundation. I like poured over block. Block foundations tend to, the mortar between the blocks tends to loosen and degrade over time, and you get leaks in your basement. And that's just not good, right? So, if you can, make sure you take a good look at the block foundation and be prepared to have to make some fixes to the block foundation. Poured foundation tends to be a bit safer unless you have some major cracks. Again, you can do an epoxy ejection to fix those things. Heating style natural gas, again, much more efficient than electric, radiant, or baseboard heating. Those are much less efficient ways to heat your property. And here in Canada, we get some pretty cold winters. So that's important that it's forced air, natural gas, instead of some other way of heating the property. It is, as you guys can see, partially brick on the front, but mostly vinyl siding. Vinyl siding is relatively easy to maintain, low maintenance, that's nice. And it's on the sewer, and it's on city water, so you're pretty much all good there. As you guys know, it's a raised bungalow. You see the finished basement, etc., etc. Let's get into the numbers here on this property. Let's see if I can figure something out and give you guys a little analysis. So what was this? This property was 137 Columbia. 137 Columbia. Now we know right now it's rented for, so at purchase, I go right into my rent schedule right away, guys. So you can see 1,700 put in at purchase. That is definitely below market value. I think on this property you could probably get, you know, if you did all inclusive, you could kind of do two scenarios, right? You could do the all inclusive scenario where you did $500 a bedroom and you paid the utilities, or you can do plus utilities to a group of students, or you can rent it to a family. Students in this area will pay more than families will for this property. So I'd say a family might pay for a house like this about $1,850, $1,900 plus all utilities. Students will pay $2,500, probably could get $2,600 if it's nice inside. I don't have any pictures inside, so I can't say for sure without going and getting more information from the agent or going and seeing the property. But given it's a 1999 built house, I assume things are relatively new inside. So we could say about $2,575, let's say, is the all-inclusive rent. So that's about what you can get for this property. Let's link up the revenue here. You see it's grabbing right into my Excel. $30,900 is the annualized amount. We're going to try and get this property for, let's say, $390,000. I don't know. I already know the market, and I know a house like this is overpriced in this area. It's funny, you'll go on the MLS and you'll see so many varying degrees of properties. And in this market, there are so many irrational buyers from Toronto and different markets that don't know London and don't know locations. They don't know, how to value a property. And so they see something for $399 and they're all over it. If it's a newer property and it's a pretty property, it'll often fetch a premium as well. And so as an investor, I could care less if it's a pretty property or if it's, a white-sided property versus a full bricked property. If it rents for more money, I get more cash flow. That's what's important. Not how nice, not whether the exterior is like full brick or vinyl siding, right? And there will be a difference in price point. Like we're talking 30, 40, 50, maybe even $100,000 difference between a vinyl sided property and a full bricked property, right? And the rent is the same. Inside they're identical, right? You probably get like almost nothing difference in rent. And so that's something to kind of consider when you're looking at properties. But so we got $390,000 property price. It's actually taking my utilities at a much higher rate than they should be because this property is overvalued, and I base my numbers on my purchase price of properties. But a rough rule of thumb is about $80 a bedroom for utilities. So $80 a bedroom times 5 will give you, times 12, will give you your annual estimated utility usage for gas, electric, or hydro and water. So about $4,800 a month in utilities you can expect in this property. It is a newer property, so I bet you I could probably get around $1,000 for insurance on this property, and the square footage was not huge. I ballpark it, having done enough quotes with insurance companies, that's about what I feel I would be able to get for insurance. The taxes are probably around $4,000. This might be a little high. I think the property is trying to sell for more than what the property's appraised for with MPAC, with the city. So I'm going to adjust the property taxes down a little bit. I suspect they're probably in the $3,600 range. I'm just guessing. Again, I'd have to go look into the system. We could go grab that detail, but for right now, we're just doing a crude, quick analysis in 5 to 10 minutes to determine whether we want to see this property or not. Once you do this a dozen or 50 times, you get to know, like I look at this property right away, I know I don't want to see this property, but I'm showing you guys so you can understand where I'm coming from. Maintenance, it's a relatively newer property, but I did see some, on the exterior it was kind of dirty. It looked like they didn't have any pictures inside, so it's possible they got some deferred maintenance going on in this property where they've been delaying, fixing certain things on the property, just been kind of cash flowing it and renting it out. Maybe they're an out-of-town landlord, who knows. Based on a couple of pictures I saw, I'm going to assume a little bit higher on the maintenance just to be safe. Mortgage principal pay down. You guys can see that our mortgage will be $312,000. I automatically calculated that at 80% loan to value. Today, the interest rates are much higher. We're looking at about 3.2 on a 5-year fixed. You can see now that we've got our mortgage principal about $69.88 pay down every month, and our interest calculation almost $10,000 a year, $832 a month in just interest cost on this property, 80% loan to value. If you went $78,000 down, and I'm assuming we do no renovation, so we just bought it for $390,000. That's it. Management, it depends on your style. I like to manage my own properties, but you could also hire a manager. Typical is about 8% of gross rent. So if you threw in management there, it'd be even worse. You'd have negative $150 a month in cash flow. So there is no cash flow. You get a little bit of mortgage pay down. So your net benefit, that includes mortgage pay down, would be about $431 before tax each and every month you're gaining before appreciation. And I think these types of properties like this one don't appreciate as quickly as a property you buy under market value. At this price range, at the $400,000 and $500,000 price range in this market, there's a bit less appreciation than at the 200,000 range. People in the 200,000 range can really afford to buy a property, and so there's a lot of demand for that right now. So we're seeing a higher rate of appreciation for the $200,000 to $300,000. Anything under about 300,000, we're seeing that in the market right now in London, Ontario. So let's look at the numbers. What is your ROI on this property? 6.64% on your down payment. And that's if you do 20% down. If you do 30% or 40% down, it gets even worse. You're gonna get like low single digit rates of return. You do have leverage working for you. So if you were to get a 3% appreciation, I'll say 2%, you're looking at an adjusted ROI of 16.6% with an appreciation on the total purchase price of the property of about 2% every year. So, not really an attractive property. You guys might think that's a great return if you're right now investing in bonds or in more basic, safe and secure type of investments where your rate of return is quite low. But honestly, I wouldn't even get out of bed for a property like this. I'm surprised properties like this sell, and there's tons of them on the market, and they sell all the time to Toronto investors and things like that. But the ROI on this property is really not very good. If this was like a duplex and we could maybe squeeze out 3+3 bedrooms, like in the upper and the lower, there might be a play to make this work. But having not seen the property, and I know properties in this location fairly well, and I'm fairly sure in that student zoning, the city will not allow you to convert to a duplex. I know the zoning will not permit, and they will not even, if you try, the neighbors will squash it. It will not happen. You cannot in this area convert. So you're pretty much stuck with a single family house. At that price point, unless you're gonna live in the property, again, it's not gonna cash flow. You just like to live in the property. Maybe that's the person that's gonna buy this property. But the listing agent has targeted this as an investment property. And what kind of investment property has like a adjusted cap rate of 5.4? That's terrible. In this market, if you're just breaking even, what's the point of buying real estate if you're just gonna break even? You're betting on appreciation. That just feels like a really risky game because none of us can really speculate and understand exactly where prices are going to go. We can make educated guesses, and that's speculation. But it's always better if you could buy a property. I'm gonna show you the next property. I haven't looked at it really in depth yet, but I guarantee you it's gonna cash flow better than this one. And it's not even half a kilometer away. In the same area, you get the same target tenant potentially. So yeah, there you guys have it. You guys can see real numbers, exactly where we're at as far as real analysis goes on a real property. The numbers just aren't good on this property. So this one is definitely, I'm gonna pass on seeing this one. There's just not a lot of benefit there. It's kind of feels like you're buying in Toronto or Vancouver or New York. It's even worse in some places like that. London in certain pockets is getting like that. It's getting very terrible. Just the returns are very, very bad. We used to see double or triple for properties like this. And to be fair, the property is under rented too. So if you were to use the actual numbers, like the currently what it's getting, if you just to keep the tenant there, because they are on a lease right now, so it might be a bit difficult to get rid of them. Let's look at the numbers with the current state of things the way they are. So you're probably just paying reliance because the tenant's probably not paying that. So reliance is your hot water tank rental. So you have just utilities down. Currently, the current landlord, if they bought this property and just continue the tenant at $1,700 a month plus utilities on this property, and they got $10,000 off the asking price, which in this market, it's pretty difficult. Things are pretty hot. You're losing $580 a month. You're losing $580 a month. So a landlord had to have bought this property at a really low price back in the day, or they're just bad investors hoping on appreciation. I say bad investors because when you're only buying for speculation, you don't have any downside coverage. So if interest rates come up or something happens, you're putting money into your property each and every month. Your property should be paying you each and every month, and appreciation should be a bonus. You should be doubling your down payment every 4 or 5 years from appreciation, and you should be seeing you really should be seeing cash in your bank account every single month plus mortgage pay down. I don't buy properties that don't cash flow. You guys can see that the payback is 4,100 years at the current rate to get all your money back. It's just, this property is terrible. If this sells, I feel bad for the person that bought it. If you're watching this and you bought this property, You guys should learn to do these kind of numbers because seriously, that property is crap based on the data that I've put in here. And maybe I've missed something because I'm doing this live, but just looks terrible. Your only play is like appreciation, and this property is fairly high price point. And less, earn more, and maximize returns to unlock a wealthier you. Let me know in the comments if you guys disagree.